Protecting against dollar weakness. You protect purchasing power by owning assets that do not care what you name the paper. You prefer productive assets, yet you keep a small, resilient hedge for currency stress. Think in preparation rather than prediction. When a currency weakens, the survivors are the owners of cash-flowing enterprises, scarce resources, and contractual claims that rise with prices. Your task is to assemble a prudent mix that works across regimes. You do not argue about the size of the leak in the bucket. You choose a better bucket and fill it slowly with discipline. Footnote. This section frames a prevention mindset and sets the objective of resilient purchasing power across currency regimes. Asset 1: Gold insurance, not speculation. You hold gold as insurance rather than as a centerpiece. It throws no cash and issues no rent, yet it can defend you when confidence in paper wanes. Supply cannot be expanded by a mouse click, and global trust has persisted for thousands of years. In a weaker dollar setting, it often takes more dollars to buy the same ounce, which offsets loss of purchasing power. You avoid idolatry and concentrate on proportion. A small and steady allocation acknowledges human and policy error without sacrificing the primacy of productive assets. Footnote. This section positions gold as a modest hedge that offsets currency debasement without displacing productive holdings. Asset 2: Broad commodities, owning the essentials. You secure exposure to energy, agriculture, and metals through diversified vehicles. Most commodities are priced in dollars. When the dollar weakens, it often requires more dollars to buy the same barrel or bushel. Scarcity and global demand create a durable floor that paper expansion cannot erase. You accept volatility driven by weather and geopolitics by keeping position size modest and diversified. You do not store barrels under the bed. You own broad baskets that translate rising input prices into protective portfolio behavior. Footnote. This section explains diversified commodity exposure as a hedge that benefits when a weaker dollar lifts nominal resource prices. Asset 3: Tips, built-in inflation protection. You use inflation-protected bonds to level the moving sidewalk. The principal adjusts with the consumer price index and interest scales from that adjusted base. You do not forecast next year's rate. You accept the mechanism that credits you when inflation appears and returns the inflation-adjusted principal at maturity. Credit risk rests with the Treasury and is minimal by market convention. You prefer tax-advantaged accounts to prevent taxation on accrual before cash receipt. You treat TIPS as a foundation that reduces real erosion under your higher risk layers. Footnote. This section defines TIPS as a transparent shield that preserves real value without requiring inflation forecasts. Asset 4: I-bonds, household-friendly savings shield. You combine a fixed rate with a variable rate that resets every 6 months from published inflation. State and local tax is excluded, and qualified education use can reduce federal tax when rules are met. Annual purchase limits and minimum holding periods nudge long-term behavior. The value does not move down even when the reset moves lower. During dollar weakness and rising living costs, the composite rate rises in step, protecting household cash reserves from quiet decay. You keep expectations modest and treat this as sturdy savings armor. Footnote. This section presents I-bonds as a principal safe, inflation-linked reserve for households with tax and behavior benefits. Asset 5: Farmland cash flow you can eat. You own productive soil that converts sunlight and labor into rent and crops. Income arrives through leases or operations, and prices tend to reflect persistent demand for food. Supply of quality acreage is finite and often shrinking with development, which supports long-run values. Revenues link to market prices that move with inflation, creating a natural hedge when currency power slips. Weather and pests add variance, so you diversify across regions or use professional managers. Low correlation to stocks and bonds steadies the broader portfolio. Footnote. This section describes farmland as a scarce, income-producing real asset with inflation-linked revenues and low correlation. Asset 6 Core real estate and infrastructure contracts that climb with CPI. You prefer apartments with frequent lease resets and regulated infrastructure with allowed price adjustments. Tenants need shelter in all cycles and regulated networks keep lights on and goods moving. Frameworks that reference inflation protect margins when operating costs rise. High upfront capital and oversight limit competition and support durable cash flows. Risks remain in regulation and management, so you select managers with prudence and align incentives. The result is a backbone of income that adapts rather than erodes when prices trend higher. Footnote. This section highlights lease and tariff mechanics that translate inflation into rising cash flows with structural moats. Asset 7 Strong currency cash and sovereign safety valves in a storm. You hold measured reserves in currencies with safe harbor reputations such as the Swiss franc and the yen. The aim is not yield. The aim is optionality and defense. If the dollar weakens, the dollar value of those reserves can rise, while short-duration sovereigns keep volatility low. This dry powder then buys risk assets at better terms when others are forced to sell. Position size remains balanced to avoid sacrificing long-run growth. The benefit is calm footing when home currency stress arrives. Footnote. This section sets strong currency reserves as defensive ballast and opportunistic dry powder during dollar weakness. Closing thoughts. Building a resilient diversified portfolio. You stop chasing prophecies and assemble cash flow, inflation links, scarce resources, and modest insurance. You automate contributions, respect sizing, and let time compound outcomes. If the dollar stays firm, you still own productive claims. If it weakens, your hedges engage while your options expand. You act like a prudent owner, not a prophet. You start small, review periodically, and keep the bucket strong so every added dollar remains water rather than vapor. Footnote. This section concludes with a discipline-first process that works across currency outcomes through sizing and automation.